there's something stirring outside the US that's even more critical and more important to look at, because it's going to directly affect all US markets.
What's going on in Korea today? The share market there has crashed more than 10%.
South Korea marked its worst trading session on Tuesday.
Korea's KOSPI stock index fell by 12.06%.
What goes up fast can't come down faster.
South Korea's financial regulator toughening regulations on single stock leveraged exchange-traded funds. New ETFs linked to Samsung Electronics and SK Hynix have been temporarily banned in an effort to protect retail investors amid sharp swings in the market.
Just 3 weeks ago, South Korea had one of the best performing markets in the world. Their main index, the KOSPI, was up over 200% in just 12 months. To put that into perspective, the S&P 500 was sitting at a very respectable 24%. But at over 200% in 12 months, the Korean marketplace was just operating at a completely different level. Now, the thing about the Korea market is it is isolated to just a couple big names. At its peak, Samsung was up over 500%, and SK Hynix, which just listed on the US exchanges, was up over 1,000%. Now, this is absolutely unheard of because that's a 10x return on a mega cap tech name in just 1 year. And why this is so crazy is because within the span of just 21 days, this entire market has completely broken. The KOSPI plummeted 25%, and 1.2 million retail trading accounts were affected. That's roughly 1 out of every 30 people in the entire country were hit with margin calls on their accounts. Now, this resulted in over $3 trillion of won forcibly liquidated by brokerage accounts in just a matter of a couple of days. Now, you might be sitting there thinking, well, John, that's absolutely crazy, but that's South Korea's problem. I live in the US, it's not going to affect me. But here's the catch. South Korea is not a separate story. It's actually a preview of what's to come. The reason for this is because South Korea's market runs the exact same leverage mechanisms that are used in US markets. They also have the exact same AI concentration and the exact same AI enthusiasm that we're experiencing throughout our marketplace. It's just happening much faster and on a much smaller scale. So to understand this and figure out why this is all actually happening, we have to look into the Korea market and figure out who's buying these stocks. Out of South Korea's 51 million population, roughly 14 million are active retail investors. Now, in a big marketplace like the US, small retail accounts don't affect the entire marketplace because they don't have that much pull. But in the Korea marketplace, when you have 14 million small players, or ants as they call themselves, and they actively are liquidating at the exact same time, this creates a massive cascade effect, and that's what we're experiencing right now. Over the last few years, young Koreans have experienced an entire market shift that's pushing them towards retail trading and retail investing. Housing prices exploded to the point where buying a home and starting a family just didn't make sense. This resulted in an entire generation deciding that the stock market was their only choice to actually get ahead. But where the issue starts to form is they weren't just going all in with the capital that they had. The Korea market is heavily leveraged, and these retail investors were actively taking out way more money than they could actually afford. But using leverage to get ahead in a marketplace that has massively overextended itself just exposes you to massive risk. At its peak, Korean retail investors had poured over 10 trillion won into leveraged products on the Korean market. And the really terrifying thing about all of this is those leveraged bets were predominantly only placed on 2 individual stocks, which was Samsung and SK Hynix. Now, the reason for this was because as the AI boom was developing in the US, US, these massive US tech companies needed more and more high bandwidth memory chips. And Samsung and SK Hynix control the vast majority of global supply of these exact high bandwidth memory chips. Koreans were seeing this as an opportunity to get into US markets and ride the AI wave without having to convert to US dollars and instead invest directly in their marketplace. In 2025 alone, hyperscalers like Google, Amazon, Meta, and Microsoft invested $375 billion into AI infrastructure buildouts. This included investment into those high bandwidth memory chips that SK Hynix and Samsung were providing. So when Korean investors were leveraging up on Samsung and SK Hynix, they were essentially making a leveraged bet that US tech companies would continually increase their capital expenditure and then this would continue on forever. Because the KOSPI isn't a diversified index, news that US tech giants might be pulling back on their capital expenditures around the AI trade sent shockwaves across the ocean, directly affecting the Korean stock market. This resulted in what now is known as a Black Tuesday, where the KOSPI dropped 10% in a single day. Now, to put that into perspective, a 10% drop in one day in US markets would signal the third worst day in US history, putting it directly behind Black Monday in 1987 and the Great Depression. Now, witnessing what happened in Korea presents us with a very, very important question. Could the exact same forced liquidation event happen here in the US? So to get an understanding of this, I want you to take a look at this chart. This measures the total US brokerage margin debt as a percentage of US GDP. Take a look at the chart and notice the red spikes throughout history. March 2000, the exact peak of the dot-com bubble, July 2007, right before the Great Financial Crisis, and August 2021, right before the 2022 tech sell-off. Every time US margin debt hits an absolute extreme, the unwinding effect that comes directly afterwards is as extreme as the pull up. As of June 2026, US margin debt officially hit 4.5% of total GDP. This is the highest level ever recorded in American financial history. This puts it higher than 2000, higher than 2007, and even higher than the 2021 meme stock peak. And here's the scary part about all of this. That official figure is actually an understatement of total leverage spread throughout the entire system. Official margin debt only tracks traditional brokerage margin loans. It doesn't account for these leveraged ETFs that are connected to single stock names. It also doesn't account for option volume, zero-day expiration contracts, or private credit leverage. The actual amount of financial leverage embedded into Wall Street right now is higher than it has ever been throughout history. So when we look at this house of cards, what is actually holding it all together? Big tech companies are currently passing back and forth billions of dollars to each other, drastically increasing their CapEx expenditures without any actual returns. This is creating a really weird situation where one company's capital expenditure is another company's front-end growth. A year and a half ago, hyperscalers were earning roughly 40 cents in operating income for every incremental dollar invested into AI infrastructure. Today, the return has fallen to around 20 cents, and it's heading down towards 10 cents right now. Now, if AI capital expenditure gets cut by just 20%, big names like Amazon and Microsoft won't be that affected. But the companies that will be affected dramatically are these microchip producing companies. This will create a trickle effect where not only will chip producers be affected, but the infrastructure producers producers will be affected, and the memory producers will be affected, and this will create an entire flux of selling across all these different stocks. Now, I don't want you to be completely panicked, but I do want you to pay attention because this is something that could directly affect your financial future and your portfolio right now. Essentially, there are two different ways that this can play out from this point right here. Scenario 1, the Korean crash remains an isolated event. Memory prices stabilize, big tech maintains its aggressive $700 billion plus annual spending throughout 2027, and the AI productivity gains arrive fast enough to justify the current valuations. Scenario number 2 is South Korea was the canary in the coal mine. It showed us what happens when an asset class fueled by extreme leverage and hyper concentration runs out of fresh buyers. When the unwind begins, forced selling takes over regardless of long-term fundamentals. Now, there's no arguing that AI will fundamentally transform our economy over the next decade, and some of these companies will be worth trillions of dollars more than they are right now. But historically, paying 2035 prices in 2026 on borrowed money has rarely resulted in an amazing story for retail investors.